Hey everyone, thanks for tuning in to the live stream. This Sunday, I'm joined by Scott with Scott's Due Diligence. How you doing, Scott?
Hi,
And
good.
we wanted to cover really the tariff, and I'm going to call it the tariff stock correction, stock crash. Kind of talk through it. Very interested in hearing what Scott has to say on the topic. I'll share my thoughts. We had quite an incredible week. We had stocks really going down in price. If you look at the last 5 day for the NASDAQ, it's down 8%. We look at the last, I'm going to call it month and a half, the NASDAQ is down 22.3%. That's really fast. This is uh, kind of the last time we saw a slide like this was when COVID was announced. And it's like, hey, there's a lot of people that are going to lose their lives and they shut down so many industries. So it's a really uh, unique time where we've seen stocks really, really crash. And the S&P is in a similar boat. Small caps are really going down, especially some small caps that are caught kind of in no man's land. They're losing price value so fast. So it's an interesting time to be an investor, most definitely. Kind of reminds you of, Warren Buffett's always said, you buy when everybody else is fearful. And other super investors have said, the time to buy is when it really feels like it's the hardest time to buy because you have to stomach the courage and buy into shares. That might be the time. I'm certainly buying shares into companies that I just want to own. I plan to own them for the next 5, 10, 20 years if they keep doing what they're doing and they keep leading their industries the way they lead them. So that's
Mm.
kind of what's going on out there. And maybe Scott, you can kind of share with, how you saw the week, what you observed, and kind of some opening comments around tariffs.
Yeah, so I know everybody's getting fearful of tariffs, but it's nothing new. It's not like we never had tariffs, and now Trump is adding all these because a tariff is a tax. It's a tax that's collected by a government. So if somebody wants to export, like China wants to export products into the U.S. So say a company in China wants to export $1 million of electronics to Amazon in the US. And let's just say, for example, the tariff for Chinese electronics is 10%. So Amazon would have to pay the $1 million of product to the Chinese company and then 100,000 to the US government. That's a tax the US government is charging. So Amazon now has to pay 1.1 million. So that if you think about it, it could be a worse thing to do than to help the government. Funding the government could potentially help the taxpayer, the US taxpayer, right? Maybe we won't have to raise taxes as much. So Trump is really just trying to shut out the competition because it's not just a revenue source for the government. That is the main thing tariffs are, but it's also a way to shut out the competition. Because if you make it more expensive for that Chinese company to export to the U.S., Apple, who is buying the product from a Chinese company, may start making it in-house if it gets too expensive. So that's kind of like the spin. All governments spin it saying we're trying to make everything in the U.S. So that's why we're raising all the taxes, the tariffs on these foreign countries. And usually you're still going to buy from other countries because even if you have this tax of 10, 20, 30%, it's still a lot cheaper than making it in the US because it's just so expensive to make products here. So, I mean, if you really think about it, it's not the end of the world, but it's a great buying opportunity. So if you wanted to buy a stock 2 weeks ago and you didn't buy it and you bought it this week, you save probably 10, 20%. because the market has gone down a lot and some stocks have gone down even more. So it's good buying opportunity. Maybe the bottom is next year. I don't know when the bottom is, but all I know is that you're getting a discount if you waited, if you bought it this week as opposed to 2 weeks ago.
Yeah, I agree. I agree that, if I like to think, a month ago, what was your investing strategy and your investing plan? And speaking to mine is, okay, I want to own companies over the long term. I want to analyze the companies minimum once a quarter, make sure their businesses are still strong, growing, leading, or doing what I expected them to do. And I want to own them for the long haul. Now, a lot of these businesses, they didn't change from 30 days ago to today. If I think about, let's say a Meta, which I released a video on, Meta didn't stop allowing people to use Facebook in the last 30 days. No, people still use Facebook. They still use Instagram. They still use WhatsApp. People are still logging into Meta. They're still on there. Advertisers still advertising. That business did not change. Tariffs changed the climate that we're operating in, most definitely, right? And I'd love to get your thoughts a little later on if you think we're running towards a recession, because I think tariffs most definitely probably accelerated the path to a recession. I think that could affect Meta. But back to, there's a buying opportunity is, well, heck, my opinions of Meta have not changed at all, but the price has changed. Well, thank you very much. I'll take it. I'll buy Meta shares. That's the conclusion I arrive on Meta. It was a stock that I have owned for a while. I've made money on it. You're going to offer me a discount. I'll take it.
Exactly. So we just have a habit of taking things to the extreme. So when there's like bad news, like we were talking about COVID earlier, people are like, oh my God, the world's ending. Everybody's going to die from COVID. And it just turned out it was not good, but it didn't lead to like this huge issue. Just more people died than a regular flu, but it wasn't like the bubonic plague or where, a big portion of the world dies. Medicine is just too advanced now for that to happen. But that's good. If you're a trader, especially if you're a short-term trader, you can play the volatility because the market is fearful. So you can take advantage of that.
Yeah, definitely. So kind of, I'd love to get your thoughts on, and again, I'll play where were your thoughts on a recession 30 days ago? And where are your thoughts on a recession now? Are we going to have a recession? Are we not going to have a recession? What are your thoughts there?
Well, I guess we're moving closer to it because the thing is with tariffs, I don't think there's no like direct correlation because like when people say, oh, how's it affect inflation? Inflation, if the US government starts buying a lot of debt which means they pump money into the economy, that's a direct correlation to inflation when you increase the money supply. But same with tariffs, there's no like, you're just making it more expensive. It's kind of like if you like chicken and that's your main thing to eat for dinner, and you also like turkey, if chicken doubles in price, then you just switch over to turkey, and vice versa. So it's just kind of, you're just moving, instead of buying from one place or one product, you're just buying a different product. Unless you love chicken and you're willing to pay double the price. But that's just what we're doing. We're just kind of moving things around. So there shouldn't be a direct correlation with anything. The concern I might have is that other countries may retaliate. So they may impose tariffs on American products that are, because we're I think the second biggest exporter in the world. So if you make it more expensive for American companies to export to other countries, then that does shut off some of our supply chain or some of the demand. But things reset, and then you have to raise prices and things like that.
Yeah, if you look
I don't
at
see it. Yeah,
if you look at like the last 5 years, right? I'm sure a lot of people are like, man, I should have bought Netflix when it was, let's look at Netflix. I mean, Netflix, I don't think anybody has questioned, is Netflix going to exist? Let's say we're sitting there.
Yeah, I picked up Netflix. I'm really happy. And I
So
was down
where
a
I'm,
lot within the first couple of months.
what I wanted to say was
Yeah.
So you look at Netflix, right? The last time we had a really good correction was 2022, and it was a pretty good one. And if you look at Netflix, right, you had the stock that went from $678 per share down to $74 per share in quick order, like in like 8 months, 7 months, right? So when you look at a stock here, and now hindsight, right, you're like, man, I wish I would have bought Netflix back when it was discounted so bad. Well, that's a kind of moment that we could probably see happening 2 years from now. You look back and go, man, you look at some of these really good stocks. I can't believe I didn't buy XYZ stock like Netflix when it was just getting hammered. It would have been a great buy. Now Netflix continued to tank, right?
Yeah.
But if you would have just dollar cost averaged into Netflix for a while, you'd be sitting on a really nice gain. So
yeah, no, I bought it in January 2022 at 388. After it was down like 40% from the peak when I bought it in January. And then after 6 months, I was down over 50% on my investment. But now at one point it hit 1,000 and I was up like 200%.
awesome.
So I'm still up like 100 something percent. But like you can't, yeah, when you see the bottom, like it's so hard to time it. You just got to be happy. You just got to get into good stocks at some point and hold them, because generally you're going to make money.
That's right. Like the way you do valuations, right? You do them on free cash flow, and you say, hey, this is what you believe the stock is worth, and whether it's discounted or being priced at a premium. And that gives you a sense of how far or how much is it discounted. If anything, you can never know if the bottom's going to be reached this week, next month, next year, but you at least have information that says, based on their free cash flows, the intrinsic value of that company is much higher. So if I buy, I believe that at some point this stock will correct and it'll go up. And we can show probably 10 examples where hindsight taught us these corrections are an opportunity. This is opportunity knocking on our door. But in the short term, it's pretty darn scary. I did not like looking at my brokerage account and seeing the losses.
I opened up my portfolio yesterday because I did the live stream. So and I lost on Friday, just Friday. Guess how much I lost?
$200,000.
No, 100. And I don't know if I've ever lost 100,000 in one day, but I was talking to my wife about it. I was like, I should be proud to lose 100,000 in one day, because in order to lose 100,000 in one day, I had to accumulate a large number. And if I did what most people do, is they stick it in bonds, I would have had maybe 500,000, maybe. But instead, I accumulated almost up to 2 million because I invested and I held and I found good stocks. Of course, if you lose 100,000 and that's your entire portfolio, that's probably not good. But it was only 10% of my portfolio.
Yeah, and I lost a pretty sizable amount, and I know family and friends tune into these, so I don't like showing my entire portfolio and showing my net worth, but let me
Oh yeah,
verbally tell you what I lost. Now, I've done really well. Last year I did great. I was doing great up until a month ago, but
we all were. Yeah.
year to date I am down $215,000. And but
Wow.
last year I made 400,000, but I'm down 215. And this just in the trading days in April, I'm down 170,000. Most of the losses have happened this past week. It's like, oh man, that
Yeah,
stinks.
but that's what happens. Like if the gains, uh, it's like a really slow burn. In order to gain a lot, it could take a year or two. But then the losses are like a week or two.
Yeah.
If you look at the market, uh, like the corrections, like COVID was the most extreme, but the market went down 30% in a week.
Right.
But it took a year to get that back, and then, well, actually, it wasn't
Well,
that
actually,
long,
it's
but
quick. It was quick. This kind of doesn't give us a really clear view, but here's 2020. Here it is. And I wish it would give me a clearer view, but it doesn't. It really, okay, I'm not seeing this right. So yeah, it doesn't show it to me right. Um,
I did a video of that. Let me see if I can find a chart.
okay.
'Cause
Yeah, because I know what you mean, which is it went down fast, but then it recovered fast. It was a real steep V. It's like came down fast, recovered fast, and then it started to really work. I think at the end of 2020, it was a positive year overall for the
yeah, let me show you my
S&P.
screen. I think I got it. I
Okay, go
found the
ahead and
website.
share your screen onto the streaming software, and then I'll add yours to the.
Okay, so the you can see my screen, right?
There you go. We can see what you're showing.
So the blue is the bull markets, and the red is the bear markets, and it shows you how long.
Mhm.
Just for example, okay, the years are on the bottom.
Yeah.
So in 1983, the market went up 228% from 83 to, I guess, 88, 5 years.
Uh-huh.
And then in 0.3 years, so in 4 months, it dropped 33%. So you see how fast the bear market is.
Yeah.
It's real fast. It's not always like the Great Depression where it lasts 5 years. It lasts a few months, as sometimes.
Right.
The
Dot-com
dot-com
bubble.
crash,
Yeah.
it went down 50% in 2.5 years.
Yeah.
But it took 9 years to grow 400%, and it took 5 years to grow 100%.
Uh-huh.
So that's just how it is. You don't have time. You don't have time. And like I think Charles said earlier, if you try to time it, you say, okay, I'm going to wait another few months because the market is not at the bottom yet. You're going to miss it. And then it's
Right.
going to start going back up. And then you don't buy when it goes back up because you're like, oh, I'm not going to buy the stock for 800 because it was 700 last week.
Right.
So I'm not going to pay 800. And
So
then it goes to 900, 1,000.
So let's put ourselves in the shoes of a couple of like make-believe investors here. First investor is 25 years old, working hard,
Yeah.
putting 10 to 20% of their income into 401k, accumulating some money on a brokerage account, and they're doing that. So if you're out there and you're that person, good job. Saving your money is always a good habit. Live within your means. So for that investor, and that's kind of, there's going to be three different investors. There's a 25-year-old, there's a 40-year-old, and there's a 55-year-old, maybe 60-year-old.
Yeah.
So what's your advice right now for the accumulating investor at 25 that's like working hard, putting their hard-earned money into an account. Then there's a 40-year-old that's been working hard for 15, 20 years, and they're continuing to contribute into the market, but they're a little bit shell shocked because they just saw a little bit of a loss. And then you have a 55, 60-year-old that's like, hey man, I'm going to start living off my money. What would you share with those make-believe investors, those three scenarios?
Well, if I just took the general rule at that age, because everybody's different, like, you know how the market went down a lot last week? Somebody I help invest, they like sold out of everything. They're like, they sell at the worst time, they sell and then, but that's the problem is people, there's only one thing I think I could do better than the average investor is that I generally don't sell and buy at the wrong time. And that's what most investors do. When the market crashes, they sell everything because they get scared. And they buy when the market is at its peak. That's when people start buying. Like they bought Bitcoin when Bitcoin was 100,000. They didn't buy Bitcoin when it was 10,000. But anyway, so just a general rule for those ages, I think you can be as aggressive as you want, assuming you can handle it in your 20s. You can be extremely aggressive, and because you can lose even your entire portfolio, which would be really bad, but it's not the end of the world. But if you're 60 and you lose your portfolio, that's it. You're toast. You're not going to be able to work full time, possibly. But yeah, so the risk factor is high in your 20s if you could handle the risk. So maybe 100% equities. But then as you age, when you get to your 40s, then some type of split, like maybe 75% equity, 25% bond, or 65% equity. And then when you hit 60, I'm not going to be doing this, but I say this is just for the average person. Then stick with money market, stick with bonds. If you want to be in equities, go with the high yield, safe dividend stocks.
Yeah.
Just a general outline.
Let me put my comments out there. Totally get what you just shared. So I'm going to start with the 60 age bracket and kind of go backwards. So I'm 56. So the way I treat it, because, I think percentages in a way, it makes it easy, but it's also could lead to the wrong conclusion. So I like to think about 5 years. I put 5 years living expenses in super safe bonds. Okay. And do I increase above that? Sometimes I do a little bit, but not much more. And my mentality there is, and I might increase that to 7 years or 8 years at some point, but I have 5 years to figure it out. And my bonds have been doing really well. I have more than 5 years of my living expenses in bonds. I have real estate and I have stocks. Now, my stock portfolio outperforms bonds for the most part. So that's how I view it. I don't view percentages because obviously if, let's say, as an example, let's say my stocks were worth 100 million. Well, I'm not going to put 30% of my stocks into bonds just because I said I was going to do 30%. No,
right.
It'd be like, oh, that's great. I only want to get wealthy once. So I am going to take some risk off the table and put those in kind of alternative asset classes that diversify and hedge some of the risks. But let's not go too far down that direction. Now let's talk about the middle-aged person. And I don't know if middle age is 40, by the way, it's still young. I would say
relative.
You gotta keep at it with equities. Equities have proven to create wealth, great wealth. And Warren Buffett, he's so generous with his life experience, and Charlie Munger was too, and Howard Marks. And you look at all these great investors that all tell you is you just got to keep, when the going gets tough, the wealthy invest more. They're like, all right, cool, discounts, boom, take them off the table. And then the young investor.
Since you just mentioned Berkshire, guys, remember he has a ton of cash. Who's laughing now? Who's
I'm
laughing
not.
now that he didn't have that invested in equities and he
He,
could now invest it? He's
yeah,
gonna kill it.
he's man, he's going to come in when stocks are so discounted. Now,
Yep.
the young investor, you're 25, you're seeing this, and I was fortunate as a young investor, 25, to be mentored by some investors that were much older than I was, and they told me to pour more money in the market, and I did so blindly, frankly, because I didn't know that if it was going to work out. That's was really good
Yeah.
advice. If you can figure out how to make a little more money, how to save some money, hey, you're not going to go on a trip this year, and you made that decision, you're going to grow your wealth during this time. And you keep learning, keep getting better at picking the right stocks. You're not going to be perfect. You're going to buy a bad stock. I've been doing videos on super investors, okay? And a lot of these super investors, guess what? They're losing money. They pick
Of course.
stocks
Yeah.
that don't work. That's fine. Even the great Warren Buffett has sold out of some dogs, but he's been a genius overall. So, young investor, lean in, put more in, stay in equities for the most part. Dabble in things that seem like a good investment just so that you can learn. Nobody could argue that like Bitcoin has been a winner. I invested in Bitcoin. I invested small amounts. It's been a huge win. And Bitcoin, by the way, last week, it did quite well. Bitcoin did not trade down with the rest of the market. It did okay. Actually, it's down a little bit now, but but overall, I mean, it was down 6%. That's not that bad compared to the rest of the market.
Yeah, it's
Um,
up. It's up to 80. So it went up the past.
So those are kind of like the lanes, if you want to be a stock investor, you want to grow your wealth, here's an opportunity. And I know that it's not publicized as an opportunity, especially through mainstream media. And I know that there's a lot of the attention is on the fear. It's unfortunate that of an investor that just totally cashed out. I mean, if you're like 99 years old, yeah, cash out. But even Charlie Munger didn't cash out of equities. He was still in it. Now, a question came out in the chat. And I think it's around your Berkshire holding. That's one of your holdings, right? So you still hold it. And how's that doing?
It's Berkshire is performing well relative to the market. Let me see. So
I have it on the screen.
Do you have the percentage versus the S&P 500? I know it's performing better.
Oh yeah.
Like year to date, it's is it up? It's up 9% year to date.
If you look at the graph, the S&P is down 13.7%. Berkshire is up 8.8%.
Wow, it's actually up. That's amazing.
It's beating the S&P by 22%.
So if you look at Berkshire's portfolio, he just owns stocks. He does own private companies too. But the majority of his portfolio is stocks. Apple's the big one, but he owns a lot of stocks. So it should be moving with the S&P 500 because he's not like extremely different. But so why is it not moving with the S&P 500? Because I think a big reason is because of that cash. He has saved a lot of money by holding cash. And I'm not suggesting that just hold cash, that's the way to do it. But if you have 1.2 trillion of investments in your portfolio, holding 300 billion of cash is not such a crazy thing. I mean, if your entire portfolio is 100K and you have 90K in cash, I'd probably say it's not the best investment strategy, but whatever makes you feel comfortable. So I'm really excited. He's gonna start. He might be gone, but I think in the next 2-3 years, he's gonna really take advantage of this market downturn.
So here's so I wanted to point something out that we just saw that the Berkshire stock is up and it's outperforming the S&P. Now I've been looking at super investor portfolios. Here is Warren Buffett's portfolio. And it's based on what was reported at the end of 2024. So it's like on January 1st, 2025, these were his holdings on the screen. And Apple's down 24%. Most of his stocks are down, right? And if you look at his portfolio, it's down 13.88%. The S&P is down 13.6. So the
Exactly.
stock is traded up overall, but his portfolio's
Yeah.
come down. And it's what you said, which is he owns some privately held companies. Overall, people feel safe in the stock, so it's traded up. But the stocks that they own, if you look at the shares, it's
That's
down. And
interesting.
while I'm at it, by the way, they own a part of the Atlanta Braves, which was kind of interesting, a baseball team.
Yeah, yeah. They it used to be TNT. What's that guy's name?
Ted Turner.
Ted Turner. Yeah. But a lot of these sports teams, or some of these sports teams, are now publicly traded. So you can own a sports team just the same way you can own Apple,
Yeah.
buy shares of the company. But they've proven to be amazing investments. Sports teams, like the value has gone up dramatically, much more than the market the past 10, 15 years.
Yeah.
Um,
So a couple
yeah.
questions that, we'll handle a couple questions. Then I want to ask you a question around the recession. So Mike, the dividend investor guy, thoughts on Meta and Google. Any thoughts on those two stocks?
Well, if you guys know me, I'm really big into I'm big into Meta, but not just that. I feel pick winners, pick stocks that are good. How do you know who's going to be a winner? I mean, if you try to pick a penny stock to be a winner, you'd be gambling all day and you probably never make money. But companies that have proven and they're successful, which are pretty much the Mag 7. Even though Nvidia, I didn't buy Nvidia, and I'm not saying it's not a successful company. I just they're the newest member of the $1 trillion club. But yeah, I put money into the big names, and it's worked out well for me. It seems like when I try to pick riskier things, it doesn't always work. So I definitely like these two companies a lot, because they just have such a strong market share. And when things get better, these companies just they have to like win overall, because they're just such a huge part of the world economy.
Yeah.
Yeah,
I
but yeah,
agree.
but
Like
I like these two. Yeah,
if you look at what's changed in the last 30 days, with these tariffs are going to be hard, especially on some industries, but I don't know that the tariffs are going to directly impact Meta and Alphabet. Like search, there's no tariff on search. The advertising, I'm not sure there's going to be a tariff on that. YouTube videos, people mostly stream for free, but there's advertising going on. So those types of business
yeah,
models are kind of tariff free. They're like,
that's a
there's no
good
there's no
point.
product. There's no like, I'm shipping it from China to the US, so I'm gonna have to
There's
charge you
nothing
another.
tangible.
Correct.
There's nothing
So
tangible. If you're Apple and you make phones, or if you're Tesla, you make cars, there's a lot of tangible products that need to come from other countries.
mhm,
Although it's not tariff free, because I think about 20% of tariffs is services, which you wouldn't think that would be tariffs on services, but a lot of kind of I can't remember the word, but like it's not like marketing services, and also like IT type services get hit with tariffs as well. Like
mhm,
if you wanted to develop code for a new type of software, a new AI software, and you employ people in other countries, that you do get hit with tariffs. It's not just products, which people probably think it's just products. It's also services too.
mhm.
Um, But I think you're right. I think their tariffs are much less reliant on tariffs than a company that makes physical products like a Tesla.
All right. So let me kind of go over it. So here's the 11 sectors, right, that stocks fit into. I'd love to get your comments on. Okay, so we are at April 7th, 2025. Looking forward, are these sectors going to perform well, performed okay, maybe not really move from here, or they're going to really be hit? They're going to perform poorly. Consumer staples is leading all sectors right now. What are your thoughts on consumer staples?
Yeah, I mean, the good thing about consumer staples and I think the most secure investment is a supermarket. But it's not a good investment because the margins are so slim, and if you're not gonna like make a huge return. But the thing, consumer staples is that's why the word staple is there. It's just that stability. So it's always going to be demand for that. It's just you're not going to be as profitable, but you do get a nice dividend. Although Costco is the only thing. Costco, you could have crushed it because that stock you could have.
Even Walmart's done really well.
Walmart too.
Yeah.
That's beginning to be a little more matured. But yeah, I wonder in the past 5 years if you because I think if you could have 5x your investment like within a 10-year, I would consider that
doubled your money on Walmart over the last 5 years.
Doubled?
Yeah.
Okay.
That's
but
not
if you're
bad.
taking it a dividend, it's probably triple if you compound the dividend in there.
I mean, you're buying into a safe stock, Walmart, right? It's not going to go anywhere. It's just humongous, and it's going to be bigger in the future, right? So it's kind of like a safe play, and you doubled your money. It's pretty good.
So if you include the dividend, because there's a website, stocksplithistory.com. If you bought 10 years ago, if you put 10,000 into Walmart and invested the dividends, you'd have $38,000 today. 277% return. So even Walmart, but Costco, if you put 10,000 10 years ago, you'd have 72,000 today. A 600% return. Not a bad return for a safe investment.
Yeah, definitely.
I should have just stuck with my guns. I was like, for ever since I started investing, I'm like, the two best stocks are Meta. Well, at the time it's Facebook. It wasn't Meta, but Facebook and Costco. And I should have just stuck with those two, and I would have like had 10 million. But you always try to like.
I have a life joke for myself. Is if I would have stuck to chemistry, I'd be a doctor. But unfortunately, I didn't. So I went in the accounting route.
Yeah.
So let me ask you about utilities. I hate utilities. And what do you think of utilities?
Kira, my cousin, my buddy, Kira, she said, any advice for a 17-year-old investor? So I definitely have advice. I probably talk to you about it all the time, but you don't talk to Victor about your life. And what would you say? I'll be right back, but you can.
So a 17-year-old investor. So I would say the most important thing is just continue to learn every month. And like at the end of the year, feel like this year, I never invested in I'm just kind of making up a scenario, but I never invested in a manufacturing business because it was pretty complex, but I learned how to analyze a company, how to view it, and kind of separate a good company versus a bad company that manufactures, let's say, batteries. And that's a pretty hot industry. So if at 17, you continue to learn each year, and of course you live within your means, you save, you save more than 10% of your money, you will, it'll be very hard not to be wealthy. You will be wealthy. It's just in the numbers. And wealth is a measure of money you have in excess of what you need. So if you're 17, you're way ahead, because I don't know a lot of 17-year-olds that are on a live stream around investing. So good job. And just stick to it. Don't have unreasonable, expectations for 2025. Try to pick a target that is doable, hard, and it really, if anything, just continues to grow your ability. And that would be the advice I would give you is, if you do that, there's just no way around it. You're going to be a wealthy investor at some point, because you're going to wake up 20 years from now, you're going to be 37. You're going to have 20 years of experience. You're going to have capital you've invested for 20 years. Maybe by that time, you're like economically empowered enough to be independent. Like, hey, you can work, not work. You can start a business. You can do all kinds of things. So you're off to a great start if you're 17 and already learning. So good job.
Yeah. But at any age, but especially younger ages, if you can get into some type of consistent saving routine, and I say that for even people in the 30s and 40s, and it doesn't matter how much it is. It could be $10 a month or $50 a month, $100 a month, whatever you can do, but just make that a guaranteed amount you take out of your account and invest it. So even $10 a week. The thing is, if after a couple of years you only have $500, but it gives you exposure, and then you start learning about it, because you're never going to learn about the market unless you have skin in the game.
Yep.
Like even listening to stuff like this, like it's helpful, but until you start actually investing, that's when you'll actually learn. So yeah.
Yeah. And it takes a while to get from 0 to 100,000. And it's kind of a milestone where it's like, wow, cool, I have $100,000. And then it takes a while to get from 100 to 1,000,000. And you're like, whoa, but it took far less time. Like you're like, whoa, I got from there to there a little bit quicker. It took a while. But then in my experience, I got from 1,000,000 to 2,000,000 fast. And then from there, it just keeps going faster. So the 17-year-old out there, I know things are going to move really slow, especially for a 17-year-old, right? It seems like when you're young, days take forever, weeks are forever, and so forth. But as you age, and it's not just an observation, kind of like the experience you have, it's just in the numbers. You start compounding your returns, and next thing you know, you're like, whoa, that's great. Like I invested in some real estate properties where my investment of $50,000 ended up having an equity value of $600,000-$700,000, and that was phenomenal.
Wow. Yeah.
And that's what keeps. So if you have a portfolio of all these investments that you it's like it's like planting a grove of trees. You started with a small investment, a seed, or maybe a sprouting tree, and it just continues to grow. And then you go back to that little forest and you're like, geez, these trees have gotten like 20, 50 feet tall. Yeah. Some of them are bad. They're bad trees, bad investments, and you got to get rid of them. You got to chop them down and burn them.
Exactly.
But
that's fine.
The winners, you're like, wow, man, look at this tree. It's 100 feet tall.
That's right. Dollar cost averaging. And then even if it goes down your portfolio, it doesn't matter, because you're going to invest $50 a month. You know what you're going to invest, because you got to stick to that plan and maybe even raise it as time goes on. So if it goes down, then you buy it at a lower price. But over time, you start to see the growth, and it gets exciting. And then you can buy a Lambo like me and Victor. And
let's talk about that for a minute, because enjoying what you've worked hard for. Here's a couple of milestones that I've enjoyed is my two sons, this younger boy is going to graduate college here in the winter. He's going to graduate in 3.5 years. And it's very gratifying to my sons. I paid my own way through college. I worked,
Me
I
too.
paid
Yeah.
my tuition, got myself through it. My sons didn't have to do that. And my sons, I basically told them, you can go to college anywhere you want. You can go to the most expensive school or the least expensive school. It doesn't matter. The money's there. I saved it. It's there. And if anything, it caused an experience for them where they conscientiously made a decision that was the best one for them. One boy went to a private school, the other one went to state school, but it was their choice. And to me, the experience was awesome, which was I really changed the experience of college for my sons. I had to work and so forth, and probably didn't enjoy college as much as the next person, but that was an experience. And here in November, I bought my wife, and we call it our car, but I bought her a really nice Mercedes, and I bought her a Mercedes 12 years ago, cash, 12 years ago. And I bought her a $100,000 Mercedes cash.
Wow.
And it feels good to walk in and just pay cash for stuff like that. And I wanted my wife to have a new car, and she had a 12-year-old car at 120,000 miles, and we're done. So for me, I used to have a car collection, a classic car collection. I had fun with it. And, but it ended up being a lot of maintenance. So I got rid of the classic cars, and now I get a thrill out of making an investment work. I get a thrill out of finding a company that few investors believed in, and I did, and then it worked. And it's like, oh man, that's the best. That's like being a scientist, and it works. So for me, the payoff is feeling, partly in the craft, partly in the art of investing. That's where I get a lot of the thrills in life now. And I traveled to Europe with my wife and my boys. My boys don't want to travel with us anymore, but I took my wife to Italy in 2023. Did we take a big trip last year? I don't think we did. And we're not going to take a big trip this year because we're going to support my younger son, who's going to do a big internship with a big company in another city. So we're going to support him for a couple months, and we're going to kind of cohabitate with him in a foreign city in an Airbnb, which is going to be fun. So
that's awesome. Yeah.
Anyway, so just some life experiences out there for a 17-year-old. I know that the younger investors, like the whole you only live once kind of crowd, where they're trying to get wealthy in short time intervals. That's really risky. I'm sure one out of 100,000 do it, and then the others wasted all their money, and that's bad. You can find ways of almost a assured way of getting wealthy, but it's a slow road. It's not a fast road. It's not in 20 days, you're going to be a millionaire. No, it's in 20 years, you'll be a millionaire. But
if you grind for 20 years to get $1 million, you'll appreciate that and you'll continue to grow. But I know a lot of people and some who accumulate a lot of money fast in the market, but they blew it, a lot of it, because they wanted to keep growing it. Like, oh, I have 100,000. I started with 10,000, and they keep trying to grow it as fast, and they end up losing it all because you don't appreciate it, or you don't have the skills to. The best way to get wealthy is to work hard, save, invest. By far, that's the best way. It's like the lotto. People win the lotto. A lot of them go bankrupt because generally people who aren't good with money don't have money. So even if you give them money, they blow it.
So I heard, so we for some reason you made me think of a story I heard. I looked at this super investor, Monish Pabre, and I did a video on him yesterday. And this guy's kind of a disciple of Warren Buffett and Charlie Munger. He's a really successful guy. But in an interview he had, he's one of the guys. Remember how Warren Buffett used to auction out a lunch with him? It was kind of like a day with Warren Buffett, and it would sell for like $20 million, and that money would be given to charity. Well, Monish Pabra paid for a lunch with Warren Buffett, and it started a relationship with Warren and Charlie Munger. And in the interview, he said, "Hey, originally there was 3 partners of Berkshire Hathaway. I didn't know that. There was a Rick Gorin. Did you know that?
No.
So there was a
No.
3rd partner." And he goes, and Warren Buffett told me this story because I goes, "Hey, what happened to Rick Gorin? He was like the 3rd partner." He said, "Well, this is what happened is Charlie Munger and Warren Buffett were like, hey, we want to get incredibly wealthy over time. We're not in a hurry."
Yeah.
Rick was in a hurry. He used leverage. He leveraged his portfolio. He used margin. And then they had a nasty stock correction in the 70s. And Rick Gorin sold his 1/3 of shares, Berkshire stock,
Wow.
because he had to, at $20 a share. Each share now is at $750,000 per share.
That's
So
unbelievable.
being in debt is a bad idea. Buying on margin, in my opinion, as an investor, is
It's no
really
good.
bad. I don't do it. I don't touch it. Somebody else, if they want to get wealthy, that's fine. But I don't want to be Rick Gorin. He was sitting on a 1/3 ownership of Berkshire. And by being on margin,
Wow.
it forced him to sell his shares. And the rest is history.
That's why you can't. I know it seems exciting to borrow, to grow. And I've seen people say that in chat rooms. Like, if I take a $10,000 bank loan and I'm going to invest it,
Don't do it.
It's no good, because it's like going to the casino and trying to win with scared money. It just never happens.
Real estate's a different game, okay? Because you're using leverage in real estate, but real estate is such a slow moving asset. It goes up a little bit, goes down a little bit. When you lose leverage properly, you can make money. But stocks is a different animal. Like you just witnessed, over quick course, you can have stocks really, really go down. And if you're over leveraged and your portfolio goes down, I think this guy, Manish, right? And this doesn't represent his full portfolio, but look at his portfolio, right? He's down 36% in the stocks he owns that are traded in US markets. I know some investors would say, oh yeah, but he's invested in India. Got it. But I can only see stuff that's in the US. So that's why I only analyze stuff in the US. So imagine you're down 36%. If you're over leveraged, you may have to, there's a margin call, and then you start selling stuff at the worst possible time and you lose lots of money. So
that's how it is.
Yeah.
But the only thing is real estate, because even people who don't use debt, that's the only thing they'll use debt for, is real estate. But outside of that, I would never use debt. Don't pay your credit cards on time. It'll be much easier in life. You'll be more successful.
Correct. Yeah, I would say, and there's some young people out there, and I know some, and if you've already made the decision, don't let it kind of ruin your experience with college. But some young people take out a lot of debt to go to school, go to college.
I did. I took debt for school too. Yeah.
Taking a little bit is not a big deal. If you can keep it to a limited amount. I also took out a little bit of debt.
That's
and
good.
I paid it off within 2 years of graduating. I got obsessive and paid it off. Okay.
Yeah. I paid it off, not in 2 years. I think 7 years I paid it off. They gave me a great rate, because I remember somebody called me out of the blue to refinance it, and it got down to like 2%. But I still paid it off. It was just a peace of mind thing. It wasn't about an investment. Like, I don't like to keep debt, even if it's low debt. That's just my mindset. It's not a practical thing. I'd rather just pay off low debt, even though I can invest it at a higher rate. But there's no guarantee in the market that you're going to beat even 3-4%, unless it's a money market. But there's no guarantee.
Yeah. There's a couple of things where debt is like it's an investment, right? It's like, hey, I like school is a good example. Just the one element of I would say caution I would put out there is, like I had a choice of going to a private school that's very well recognized in California, and it was going to be like 20 times more expensive than the school
Yeah,
that I ended up going to. And I uh,
I the same
actively
thing.
made
Yeah,
that decision that no, I don't want that debt. I want the education with this other school. And it turned out really well. I mean, my career is, it went far better than I expected. And I learned a ton. Now,
yeah,
if the two schools were priced the same, I would have gone to the nicer school, frankly, because I thought it was a nicer school and cooler, but it was a big price to pay. And
yeah.
that's
I
one
did the
thing
same
that,
thing. I went to community
yeah,
college for 2 years, and it's not on my resume because I graduated from the university. So there's no reason to put community college. I have my degree from the university, but they don't know I did that, and I saved a ton of money.
yeah, yeah. So to start making like decisions, you're making an investment in yourself. That's great. And, you know, it's almost like saying, hey, you could buy Meta stock, like the education, right? Is if you go to a private school, you get, you have to pay a higher price for the same stock. You get a degree. Now, better schools are going to get you potentially a better job or more doors will open. I would have to admit to that. But you have to assess, am
Absolutely,
I
yeah.
am I excessively paying for maybe a couple extra doors to open? Or could I just make it up by being, harder working, more opportunistic, more of an entrepreneur? So good stuff. So I wanted to get back to this recession. So what's your best expectation on, because I think first off, the tariffs are obviously having a dramatic impact on stock prices.
Mhm.
What can be another negative story is that uh, economic data comes out and we validate we're in a recession. And what's your expectation on recession? Is it here? Is it coming? Is it not going to come?
Um, I don't see it. I just think it's just we're too strong of an economy, the U.S. and the world economy, and I think if it does happen, you won't even realize it. It'll be that minor. That's how it is a lot of times. Um, like if you talk to somebody, say it was the year 2050, and somebody was like a teenager was talking to you, like what was it like in COVID? Were people just scared to go outside? Were people just dying on the streets? That's what they would think by reading about what was said of. Because, but you'd be like, if it wasn't on the news 24/7, you wouldn't even think about it. You just live your life. But they talked about it so much. Um, so I do think there's going to be a correction because I think, and that has been last week, but I think it'll be minor. And even if we technically go into recession, which is what, two straight quarters of negative GDP, I don't know that, or there's a definition. I don't know.
Two quarters of contracting GDP.
Yeah,
So this
I
is
think you won't even realize it.
so this came out and actually came out about a month ago. It's a little blurry, I apologize, but this is, how the Federal Reserve has different regions, and the region of the Atlanta region, that particular, and they call it the Federal Reserve president of the Atlanta Fed. He came out with this and said, "Hey, we've already started to contract first quarter 2025."
There you go. Yeah.
So it's like, okay, this came out and it caught some attention because people are like, well, it's hard to argue with it because it is kind of a little bit slow. If you look at airlines, and Delta announces this week, by the way, so I'm going to be curious to see what they say. The airline ticket sales have drastically dropped. They have slowed down. The travel industry, if you look at travel stocks, really bad. Airbnb's down, like Marriott and all those stocks are down. And Delta, United, Southwest, and American, those stocks are down drastically. So I think
Yeah.
certain industries are certainly feeling it. And some are kind of like you were saying, like, hey, it's no big deal. Like, for example, like Staples, right? Everybody still goes to the grocery store. Everybody still goes to Walmart. But it'll be
Yeah.
curious to see how like home improvement will do. Like, are people going to be optimistic enough to say, yeah, I'm going to spend $50,000 remodeling my kitchen?
Hmm. Yeah. Yeah. No, it's a good buying opportunity. That's the main thing. That's what I think about when I see market go down. Of course, you need cash to buy if you're all baked into the stock market. But if you work every week or two, you're getting cash. So dollar cost average, build up your portfolio. Maybe adjust. Maybe there's things you're invested in that you don't really want anymore, and put into something else. Maybe something is down more than, like Delta is down like almost 45% from the peak, and the peak was just in January.
Yeah,
Um,
man. So yeah, the travel industry saw like just people stopped traveling. They were like, okay. And they attribute that to a couple of things. Maybe I think part of it is travel was booming so much. I think people kind of were like, okay, I took a couple of trips. I don't want to travel anymore because I'm tired. I don't want to travel this
yeah,
year. And second is, I think there is a confidence difference. Like people are like, whoa, wait a second. I think things are going to slow down. And now with these tariffs, it could only make the situation worse because, I mean, you look at cars, right? Like, if you were looking to buy a car last week and you're like, oh, I'm going to go buy a $50,000 car. And you're like looking at it and saying, well, my overpaying, underpaying. Well, this week it's like, oh, FYI, that might be 25% more going forward. It's like, whoa, okay.
yeah.
And I think it's
Um,
created short-term increase in demand in car sales, but long-term, I think it's going to be harder for people to buy cars.
yeah, that's just how people adjust. You may, instead of buying a $40,000 car, you buy a $30,000 car. You adjust. You may have to like now move and pay 1,500 a month for rent instead of 2,000. Um, so yeah, but then things always revert back after the adjustment. Um,
Mm-hmm. So off the cuff, right? So one of the companies that's going to announce this week is CarMax, I believe. Let me double check.
CarMax.
So CarMax. So follow me logically here. So you have the car business, you got a tariff war, and obviously like a Toyota that's made in Japan is going to be more expensive, and a Mercedes that's made in Germany is going to be more expensive, and so forth and so on. Cars that are made domestic will probably be about the same, but they have a lot of parts that are made elsewhere. So CarMax is sitting on an inventory of used cars. I think their inventory value is going up. That's my observation is like, well, their inventory just
Right.
gained value. So they're going to announce here on Thursday. Is that right? Yeah, Thursday. And I'm like, man, maybe I should buy some CarMax stock. Um, the stock hasn't been having a great year. Um, and if we look at the market cap's 11.65 billion, it's you're paying for a fraction of the revenue. PE is 19. Not a lot of growth. They had that great year in 2022 when car values really went up because of the
Mm.
scarcity issues, the supply chain issues. But ever since then, not so great. Free cash flow is 337 million, but it's been all over the place. Up 500, down 2.8 billion, up 860. So it's not an obvious like, wow, these guys are just killing it situation. So this one may not be a good idea.
I mean, CarMax is a little different animal because they pretty much buy used cars and then just pawn them off to someone else who wants to buy a used car. They don't manufacture anything. So they do have inventory, of course. Everybody has inventory. Every business is always going to sell some inventory, but they're kind of flipping their inventory. They're not really too reliant on tariffs, except for the fact that tariffs could just have a trickle down effect. So yeah, it's an interesting company to look at, and I think it's performing pretty well this year, considering probably beating the market by a lot.
Yeah, the market. I mean, the S&P is down 13.5. This one's down 7, which is beating the market. So
yeah, that's pretty good, down 7. And at one point, well, last week it was up, but I guess the past week everything dropped.
It was going up nicely from the 13th of March up until the 2nd of April when the tariffs were announced. I mean, everything kind of fell apart once the tariffs were announced.
Except gold. Gold is up, I think, quite a bit.
Yeah, agreed.
That's a good hedge.
So
and Bitcoin's probably up too. Probably good hedge.
And although Bitcoin dropped to 79, according to one of the comments I just saw, Sabir 2 said it dropped to 79,000. So tomorrow, Levi's is going to announce. Interesting. And then on Tuesday, Walgreens. That's kind of a staple. And then RPM, I'm not familiar with RPM. Okay. And then Wednesday, Delta, Constellation Brands. But Delta is going to tell us what that traveler's doing. And I think, like you said, the Delta stock has been really hurting. And it follows kind of like what I had been observing, which is travel is really falling off a cliff. Look at that. Man, 46% since February 4th. Oh, man. Ouch.
It's Richard Branson. They say, they asked, how do you become a millionaire, Richard Branson? He said, well, first you become a billionaire and then you buy an airline.
Yeah. And you know when to stop.
It'll burn it burns cash. It's such
look
a
at this
business model.
Look at this round trip here. August 9th, you buy Delta stock, you establish genius level investing ability because your stock's up 71% in 5 months. And you stay in the stock and you come right back down, and now you're down 5%. Wow.
Airlines are never a good buying opportunity. I'm not saying you can't make money in airlines, but
you got to know when to get out.
In the long term, they go down. It's a terrible business model. But why are airlines around if it's such a bad business model? Because we need them to live. Ever since planes were invented, it changed the world. We can now visit people in other countries. We weren't able to do that in like the 1800s. We can now transport goods and services. So it is quasi subsidized by the government. The government will not let airlines fail. So they're always going to be like backed in a sense. Obviously, they're still private companies, but
look at United. It had a similar, from August 2nd until February 7th, stock was up 171%.
See, if you trade
5 months
volatility, or if you trade short term, you can make a ton of money with these types of stocks. High beta, really volatile. But the thing is, you would have had to sell because you how would you know that was the peak? I guess you can get lucky and sell at the peak.
So on stocks like these, I say like on airlines, the shipping stocks, when you buy a stock, you need to define your exit strategy. You can't stay in these stocks for a long time. It's not Meta. It's not Apple. It's not Berkshire. It's not Costco. Those suckers, when I wake up 10 years from now, I expect Costco is going to be worth more. Okay. That's a foregone conclusion. But these, no. I think these are going to do well for you have your reasons. Okay. You buy at 41, you need to say at 60, I'm out. Don't get greedy, because who would have known that it would have gone up 171? And then who would have known that it's going to turn right back around and come down? So from
Yeah.
the high point to where it's at now, which took what is it, about 2 months, 47% drop. So that's how I invest in these. Like I invested in Zim, which to me, shipping stocks, airlines, there's kind of certain industries that I feel that, like, similar to how you feel, is over time they just don't accumulate value. They don't compound. So you need to define your exit strategy when you buy. All
Yeah.
right. Good stuff. So
It's
I
true.
think those are the big earnings, but I think it's going to be kind of like these are going to be setting the table for other, like the car business is going to be in the spotlight on Thursday, and we'll see how car stocks trade. JP Morgan on Friday. That's going to be big.
That's a big
That
one. A lot
one.
of banks on Friday. Wow. It's
Yeah.
all bank.
Oof.
Um,
Big Friday.
so
It's go ahead.
yeah, so like if you're invested in a bank, for instance, and if, say B of A, once JP Morgan reports earnings, if it's really good, B of A goes up even before B of A announces. And if it's really bad, B of A goes down because investors assume the competitors will have similar results. I'm sure you guys noticed that when remember that time Meta was reporting awful earnings and it was bringing down everyone with them.
Yeah. So JP Morgan and banks have just been getting smashed.
Yeah, I have
Look at
a
this.
bank
Like
stock that's
February
struggling.
18th to now down 25%. And this is like the best, like the most sought after stock is JP Morgan. And I know Citi has gotten hammered because I own Citi. And Citi is down 31% year to date. I mean, from the high point to now. So these guys, as soon as the sell-off started, and especially as we hit the tariff war, I mean, it's down 19% in the last 2 trading days. It's just been killing the banks.
Yeah, tariffs seem to affect banks. So sometimes you don't even realize the connections until it happens. So now we can use this information for the future. But yeah, apparently tariffs really affect banks. I guess that makes sense. Yeah.
So Friday will be probably the most interesting day of the week. But I think the earnings maybe help us process some of the tariff, entanglements that we're going to have.
It'll give us comfort when we realize companies are still reporting solid earnings. Tariffs haven't had any effect because it shouldn't have, and there's no direct correlation with tariffs. It's all indirect. And but like I said, people are just going to be moving. Instead of buying Chinese products, they may start buying U.S. made products and willing to just eat the extra cost, um, which isn't a bad thing to buy U.S.
Yeah, agreed. All right, so it could be a really good buying opportunity. I think the overall, the slide, it happened so fast that I'm like, man, it just feels like it went down way too much, way too fast. We kind of knew these tariffs were coming. We knew they were
Yeah,
coming when President Trump won. Okay.
right.
He said he was going to do tariffs. So I got to think, okay, people price them in. Now, how long are they going to last? Like, I don't know,
Yeah,
but it makes me feel like I wouldn't be shocked if some of these countries, started negotiating and we resolved the tension between some of these countries. And then it kind of started. That was the first domino that dropped. And then other countries were like, yeah, let's just get this thing off the table. We don't want to completely disrupt our economy. And they start making deals just to get this story behind them. I'm I'm hoping that happens. I don't know how soon that's going to happen. If it's going to happen in a week, in a month, in a year. If it happens in a year, man, we're we're going to be in this for a while.
I remember in 2020, it was 21 or 22 when my portfolio was down like 30%. I couldn't even look at it. I was getting killed. Meta went from like 400 to 80.
Oh, I know.
Was that 21 or 22? But it was
22,
just brutal.
2022.
And it, when you look back, it doesn't seem like a big, when you look at a chart, it doesn't seem like a big deal. But when you're living it for like 18 months, it's just like,
yeah.
But I mean, I wasn't like going to jump off a bridge or anything like that. I knew it was going to come back. I just, you know, I would prefer my portfolio to go up rather than down 40%. But so
I would say that my comments, you know, this part of the year, like as we approach the end of 2024, I was selling some stocks. I was especially selling some stocks where I thought, okay, I made a good gain and I'm out. But I just was creating more cash. Part of it was, you know, Warren Buffett was creating a lot of cash, and it's like, you know, he didn't start creating cash last week. He started creating cash in the middle of 2024, and he was selling off Apple. He was selling off like some really kind of big investments they've made, and he was also getting out of some dogs. Like he got out of was it Warner Brothers, and he got out of what was that beauty product company he got into?
Oh yeah, I can't believe it. Ulta
Yeah.
Beauty.
Yeah. And one of the Warren Buffett rules is don't invest in something you don't understand. So that one I was like, what does Warren Buffett know about beauty? But maybe he knows a lot about it. I don't know. But not long and the short of it is I started accumulating cash back here, and it kind of felt weird, you know, on live streams and on videos saying, hey, I'm accumulating cash. This is going to last. This isn't going to last forever. And with the same sentiment, this sell-off, I mean, look at this sell-off. Holy smokes. See this graph? This sell-off's not going to last forever. It's not. We're already negative on the 1 year in the NASDAQ. And back here in December timeframe, the NASDAQ was up 28% or so. It was like we went from positive 28 to negative 4 really fast. So having said that, the same sentiment I was having back here where it's like, this isn't going to last forever. When you have this upward slope, right? Like on the NASDAQ, you're up collectively 90% over the course of 2 years. That's great. That's awesome. But that's not natural. It's like, we have to have a correction, and we have to see stocks, especially the ones that were euphoric, AppLovin, Palantir, Robinhood. And I showed you where United and Delta were doing. That was that was exuberance. That was like stocks beginning to take off and not being tethered to valuations. So I think the sell-off is overdone quickly, and I think we're near the bottom. It would be my guess. We can continue to go down, but boy, that's going to really create a lot of opportunity.
Yeah, exactly. So don't quit your jobs yet. Keep working, earn a salary so you can put into the market and get these discounts. Exciting, very exciting times.
Yeah. So
okay.
Where do we go from here? Is there anything else you wanted to come up, talk about?
No, I think we kind of did a lot. But I think at one point there was almost 50 people on the stream, right?
Right now I'm seeing 68 total. I guess that's with your attendees and mine. Yeah.
We're
currently at 67. Yeah. We've been operating at like that level for about an hour.
According to YouTube, it says 33 watching, but maybe that's not updated.
I'm streaming on X, Facebook, and YouTube. So it's when I see 60 right now, 66, it's across all platforms. So.
Oh, I see.
But once I'm done, I'll be able to see how many were just on YouTube.
Oh, I see. This says YouTube only. Oh, wow. Amazing. I started live streaming once, and I don't know why, but I was getting like 100 viewers, but that only lasted a week. Then it went
Oh,
back down to like, I have to come up with more like kind of
yeah.
like noises or
I had
things.
I had my best, like this stream's really good. We got a lot of people watching. Um, but the stream that I did on the day of the crash or the day after, the morning after, I had my best individual stream. I got up to like 80 combined
Wow.
viewers because I think
That's a lot.
everybody was like, "What the heck is going on?" Like,
Yeah, they weren't
and
curious. I may stream later. I mean, it's fun when you get a lot of viewers.
mhm.
It's depressing when there's like 3 people in there.
Yeah, I've had some streams where I mean, I was exhausted at the end because I covered like 30 stocks and I viewed
Yeah,
them, and I realized that man, I was exhausted at the end, so I kind of had to learn to pace myself, and I
yeah.
slowed things down a bit and made it a little like, hey guys, I'm not going to be able to cover all the stocks because it's just we're going to run out of time, but I had to pace myself going forward. Right, cool. So thanks so much for joining the stream with me. It's great to see you. And
Yeah,
if
yeah.
you, I'd love to get on again, hopefully in a week or two, and we're talking about how the market's up 10% really fast, and how we're beginning to go up
Do you
again. But who
do you
knows?
have
Maybe
a
we'll
third?
be.
Is there a third person? Is there someone you stream with a lot? Maybe we can do 3 of us. No?
There's a
Uh,
trader, but he's like full trader mode. His name's Trader Prad. He'd be up for it, I
yeah, I think I see
think.
his name. Yeah.
But I mean, he would take us into the conversation of how, which might be interesting, which is, on days where you see the market selling off quite violently, it's kind of music to his ears because he's making money when stocks are moving, and it'd be interesting to see how he's making money. If anything, just to be a fan of it. It's not that I'm going to invest like that. I'm not going to trade like that. But it'd be interesting to
Me
see
neither.
how traders are making money right now.
I did buy a couple of options trades, and I was slightly off. I bought Mister. They buy Bitcoin on they
Uh huh.
lever they sell convertible debt to buy Bitcoin. And I shorted them when Bitcoin was 100,000, and but then Bitcoin went to 110. So I think if I would have waited a little longer, because it's a timing thing. Even if you time it, even if you even if you identify a stock that goes down, but you're off on timing a little bit, you might not make any money, especially with options.
So
But
I shorted Nvidia, and I started saying I'm going to be short Nvidia at the end of May, and fast forward. So I did a couple of things. I shorted some shares. I was in it. I got out of it. I got out of that short position, but then I bought a long-term put option, and it was basically I picked a high point and then I bought that option for a
yeah,
year. It expired January of 2026. And very quickly I was able to make like 35% on that trade,
wow, yeah,
and I got out.
that's good.
But I it's good to experience things like that because I did see Nvidia and I thought it was overpriced, and I did rationalize why, and I created videos and I put my analysis out there, and um, I went, like when I first published it, I did get a lot of criticism and a lot of pushback by a lot of Nvidia evangelists. But now those same evangelists were like on common ground. They're like, okay, we see what you meant, which is cool. It's very gratifying
Yeah,
to have that type of transformation in one stock. And where Nvidia is going to go, I think long term, this is going to be a great business, especially if the data center keeps building. But I think Nvidia could really test $60 a share because it's on its way down. I mean, you look at where the Nvidia stock, its high point was $150 a share. It's down 37% from that high point it established in January. And the momentum is downward. And you're going to hear the data center companies like AWS, Amazon, Microsoft Azure, Google Cloud communicate what their plans are in the data center. And that's what's going to make or break NVIDIA. And I have to guess that those three businesses are going to say, we're going to play it safe. We're going to play it real safe because the economy, we don't know what's going to happen, but we're not going to spend a ton of capital in the data center. That'd be foolish. We'd probably be fired as leaders of these companies if we said that. So they're going to guide to be careful with their CapEx, which is then going to be a negative reflection on NVIDIA, where it's like, okay, guys, you're not going to keep growing because the data center giants are going to stop spending. So that's one stock that obviously it's an interesting stock because it did so much. It was at $3.5 trillion in market cap value. It's lost over $1 trillion of value. It's just the incredible, that's the most interesting stock that I've seen in the last 10 years.
Yeah. I mean, Microsoft isn't doing well either, so I don't even know what's going on.
But they're not doing as bad as everybody else. You look at, let me show you the top stocks.
Okay.
You look at, here's year to date, right? You can see my screen. Apple's down 25. Microsoft's down 14.6.
Oh, I thought so it's not bad at all.
NVIDIA's 30. Amazon's down 22. Google's down 23. Meta's down 13.8. Berkshire up a shiny positive 8.88%. Tesla's just getting shellacked, down 40%. What's your opinion on Tesla?
Because of Elon, it's not really, there's no connection with Tesla financials and a stock price. There's zero correlation. It's all about Elon. But I have read that their sales are going down, and which makes sense because people are mad at Elon because they think he's a Nazi. I don't think he meant that, but to be a Nazi, but people are vandalizing Tesla cars, so they don't want to buy it. So might be a good time to get out of Tesla because I don't know, or short Tesla.
I mean, Tesla is such a risky stock to short because and I'll show you my valuation on the stock, but just look at the 1 year. I think this is before the election up to the high point. Tesla stock went up 124%. Incredible.
Yeah.
But since that high point to now, it's down 50%. Oh man. Now, if you were like Tesla's overrated, I mean, I think Tesla, the business is not desirable to me. They don't make a lot of money. If you look at their business, it's a car business, low margins, low cash flow. I think they're 85% overpriced based on cash flow. Okay. Some people would argue it's a technology business. Now, I would point out a couple of things. First is, if you look at the XAI IPO that Elon Musk is going to have, that's a valuable technology. It's AI. But Tesla stockholders are not going to get any piece of that company. It's going to be IPO'd and Elon Musk is going to get wealthier. So if you're investing hypothesis on, or thesis, I should say, on Tesla is, well, I'm investing in a technology company, but the founder is taking those technologies and IPOing those portions separately. You're not getting any of the value. So be aware of that. So just study it. I could be wrong, but my observation on XAI is and look at SpaceX. SpaceX is a separate entity. Tesla shareholders do not get any value from SpaceX or XAI.
Right. Yeah. They're separate. But yeah, sounds good. So it's a good stream. No donations.
Yeah. No donations, but it was a great conversation.
Yeah. Okay. Sounds good. So yeah, let's do it again soon. I'll talk to you over email about it.
Yeah, let's do it. Thanks, Scott. Enjoy your Sunday.
Okay.
Good luck.
Thanks, everybody. Okay, bye.